Yes, thank you for the question. So I think on a very high level that we have said this quite a few times that in terms of interest rate cycle, that we are probably approaching the end of that. And I think what we are seeing now is the higher level of interest rate are actually having a material impact in certain parts of the market, like the stock market, maybe the housing market, and a lot of leading indicators in the US or even in Europe has started to trend downwards. And I think at the same time, if you look at what's going on in China, that China is sending a very deflationary signal in terms of commodity prices, etc. So I think we would agree that we are approaching the end, despite the Fed hasn't changed their tone yet. They still like to probably take the rates up a bit higher from here, but maybe we are likely to be ending at the peak soon.
Well, Stephen, on that basis, then, I know you recently cut back on your big tech holdings, Google, Meta, Amazon. Clearly, those stocks are very interest rate sensitive. If it looks as though we are approaching the peak in terms of hawkishness from the Fed and maybe other central banks, is it time to consider rebuilding some of those positions?
Yes, this is a very interesting and important questions because basically there are two things to consider. I think if you want to take a short-term view on interest rate and inflation, assuming that they're going to trend downwards from here, I think a lot of the stocks that have been sell off dramatically over the last year or so would recover, like whether they are Facebook or Amazon or even like maybe Peloton or some of the names that are very much loss-making. I mean, I think they would bounce back quite quickly. But the way that we see these companies about what they're going to experience in the next couple of years compared to the last couple of years, I think the headwind in terms of the consumer disposable income being squeezed, which links to Amazon's e-commerce business, in terms of the wages inflation, that's not going away anytime soon. And then I think on the other hand, we recently exited our position in Alphabet Google. And I think if you just look outside North America, I think the economic outlook is quite bleak in terms of where we are heading in the next few years. So if your business model is built on advertising budget, then I think you can expect that to be cut or being more of a headwind than a tailwind in the next few years.
I'm interested to see that some of your largest positions are in the chip makers. You own positions in ASML and NVIDIA. It has not been a great year for the chip makers. Those names are down 40 to 50 percentage points. What is the longer term view?
We are a big supporter of reshoring of silicon or semiconductor production capability into the Western world. I think if you follow a lot of these things that about the CHIPS Act in the US and also the similar kind of package in Europe, and we are building new fabs in Italy, in Germany, in France, and in the US as in multiple locations, I think that trend have not change. And I think that what happened recently in terms of what the US is trying to do to bar certain export to Chinese company, I think it reinforced the view. But I think unfortunately, when we are in the middle of that transition, which is this year, I think at the same time that we are probably going through a bit of recession here in Europe, then they are selling less of their chips to PCs, to gaming, or even to smartphones. So I think this year is one of those years that is a transitionary phase, but the long-term thesis remain very much intact, if not stronger. So we would think a lot of the share price reset this year would recover in the next couple of years, and if not, going higher from there.